Hello and welcome to Explain the Charts, your go-to channel for detailed market analysis. Today is October 24th, 2025, and we are taking a deep dive into the US dollar versus the Japanese yen, or USDJPY. This pair has been on a tear, rallying for 4 consecutive days and currently sitting near a 2-week high around 152.60. The market is buzzing with activity, driven by significant fundamental news from both Japan and the United States. Let's first cover the headlines that are fueling this massive move. The primary driver right now appears to be significant weakness in the Japanese yen. This stems from the new cabinet in Japan, led by Prime Minister Sanae Takaichi, who is known to be a fiscal dove. The market is now pricing in a massive economic stimulus package, rumored to be around $90 billion. Such a large injection of cash is expected to boost government spending, but it also strains public finances and could hinder the Bank of Japan's plans for monetary tightening. Essentially, loose fiscal policy is clashing with the potential for tight monetary policy, and for now, the former is winning, pushing the yen down. On the other side of the pair, the US dollar has remained moderately bid, partly due to safe haven demand from renewed trade frictions between the US and China. However, the big story for the dollar is the delayed US Consumer Price Index, or CPI, data which is due to be released later today. This inflation report is a critical piece of the puzzle for the Federal Reserve's future interest rate decisions, and traders are clearly on edge waiting for it. Also on the calendar today is Japan's own national CPI data, which is expected to show rising inflation and could offer some support to the yen, but the market seems more focused on the stimulus news. Now, let's turn to the charts to see how this news is reflected in the price action. Looking at the daily chart, we can see a clear and powerful long-term uptrend that has been in place since the major bottom formed back in April of this year. After peaking in late July near 155, the pair saw a sharp correction down to the 141 level in early August. However, since that bottom, the uptrend has decisively resumed with a clear pattern of higher highs and higher lows. The psychological 150 level was a major hurdle, but the price broke through it with conviction just last week. Yesterday's candle was strongly bullish, closing very near its high and showing significant upward momentum. This confirms that buyers are currently in firm control of the market on a longer-term basis. Let's zoom in on the price action since the beginning of September to get a better perspective on this recent surge. As you can see, the price consolidated for much of September before starting a powerful leg up in early October. This rally directly correlates with the news surrounding Japan's new leadership and the growing expectations for a major stimulus package. The move from the 147s to above 152 in just a few weeks is a testament to how impactful these fundamental drivers have been. Now, let's identify the most important price levels on this daily time frame. The most immediate resistance is the recent high set on October 10th, right around 153.27. A clean break and close above this level would be a very strong bullish signal. If that happens, many analysts believe the path would be open for a test of the February high near 155. On the downside, the first key support to watch is the low from that October 10th pullback, which sits around 151.15. Below that, the 150 mark, which was previously strong resistance, should now act as a major psychological support zone. If we were to break below 150, the next significant support area is down around 148. To get a better feel for the current momentum, let's switch over to the 1-hour chart and look at the action from this week. Here we can see the aggressive buying pressure that has defined the last few days. The price has been grinding steadily higher, forming a clear ascending channel. However, in the last several hours, the momentum has stalled, and we've entered a period of consolidation right below the 152.80 level. This tightening range strongly suggests the market is pausing and holding its breath ahead of the US CPI release. For intraday traders, the key support level is the low from earlier today, around 151.96, and also yesterday's low around 151.96. A break below this level could signal a short-term reversal or deeper pullback. The immediate resistance is the high of the current session, right around 152.79. A breakout above this level, especially on high volume after the news, would confirm the continuation of this bullish move. Finally, let's drill down to the 15-minute chart for the most granular view of the price action over the past day. This chart clearly shows the market's indecision as we approach the news event. Price is trading in a very tight, choppy sideways range, roughly between 152.50 and 152.75. This is a classic holding pattern, as large traders are likely sitting on the sidelines, waiting for the CPI data to provide a clear direction. The key takeaway here is that a high-volume breakout from this tight range, either to the upside or downside, will likely dictate the market's direction for the remainder of the trading day. Aggressive traders might look to trade that breakout, while more conservative traders will wait for confirmation on the hourly chart. So, let's switch back to the daily chart and recap what we've learned and what to look for. The long-term trend is undeniably bullish, supported by fundamental weakness in the yen. The market is now coiled in a tight range, awaiting the US CPI data as a major catalyst. Let's summarize the key levels once more. Major resistance is at 153.27, with a further target at 155. Key support lies at 151.15, followed by the crucial psychological level of 150. Now for some potential scenarios, keeping an unbiased perspective. First, the bullish scenario, which I believe has about a 70% probability given the underlying trend and fundamentals. If the US CPI data comes in hotter than expected, it would likely strengthen the US dollar. This, combined with the ongoing yen weakness, could easily propel the price through the 153.27 resistance. A sustained break above that level makes a rally towards 155 highly likely in the coming days or weeks. Next, the bearish scenario, which I see as a 30% probability. If the US CPI is significantly weaker than forecasts, we could see a sharp sell-off in the dollar. If this coincides with a surprisingly strong inflation report from Japan, it would be a double whammy against the pair, potentially triggering a sharp reversal. A break below the immediate support around 151.90 would be the first warning sign for bulls. A move below 151.15 would confirm a deeper correction is underway, with 150 being the next logical target. So, the things to watch are, first and foremost, the US CPI report later today, followed by Japan's CPI data. Also, listen for any official details about the size and timing of Japan's stimulus package and any verbal intervention from Japanese officials concerned about the yen's rapid decline. Before we wrap up, I must remind you that this is not financial advice. This analysis is for educational and informational purposes only. Always conduct your own research and consult with a professional financial advisor before making any investment decisions. Trading involves a significant risk of loss, and you should never risk more than you are prepared to lose. Thank you for watching Explain the Charts. If you found this analysis helpful, please hit the like button, subscribe to the channel, and we'll see you in the next video.